GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we break down crypto like kids playing hopscotch, one step at a time. I'm your host, Jay Hamilton, and today we're joined by the co-founder of Tether and Wax, William Quigley. We're going to discuss the past, present, and future of crypto's biggest use case, stablecoins. Before we jump into today's episode, less than 50% of you listening to this subscribe to our channel. And we want you to subscribe. So to celebrate that, we're giving away some amazing prizes right now. All you have to do is subscribe on whatever platform you're listening to by the end of August. And before we jump into today's show, we're just going to take a minute to hear from our fantastic sponsor over at Kelp. Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karuk, and more. Here's how it works. Head over to milkroad.com/kelpgain and spot airdrop gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AgETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live and you can go check it out for yourself today. Just head over to milkroad.com/kelpgain and get started. William, welcome to the Milk Road Show. Great to have you today.
Yeah, good morning.
I want to start off with, we actually just wrote a newsletter about this, about how Tether is one of the most profitable companies in crypto. It might be one of the most profitable companies in the world, especially on a per head basis. Did you think this would happen when you founded Tether?
I co-founded it, so I didn't found it, but I played around with the spreadsheet. I can say that. And, you know, if we have 10 million, what can it do? 100 million, a billion under management. I didn't go beyond a billion. And now it's more than 100 times that. But also, you know, when my partners and I started Tether, it is, I guess it's ironic that, you know, we did it as a charitable act. We did not do Tether to make money. We did Tether because we needed it for what we wanted to do, and it looked like the right answer. Yeah, I guess that is irony. The fact that it was kind of founded as a charitable contribution, because we were all, I don't know if this ethos is still there in crypto, but we were all so appreciative of the whoever the people are who created Bitcoin, which allowed this whole industry to grow. We were very appreciative. That had also been done as a charitable act. Mm-hmm. And so we didn't expect it to go where it went, but anyone with a spreadsheet could see, well, you know, especially if rates went up. Remember, rates were basically zero at that point as well. So we didn't expect it really to make much money, but it didn't take much money to run. So, you know, there you have it.
And when you say that you were solving a problem that you saw, what was it that you set out to do when you first wrote the plan for Tether?
So I'll try to be very brief on this, but there was a series of things that seemed to be problematic when trying to exchange cryptos back and forth with people. The most obvious one to anybody who does any kind of arbitrage is that the only way to arbitrage profitably is for one side of the trading pair to be stable. Mm-hmm. Otherwise, you have two different things that you're holding and receiving. And at the end of the day, are you better off or worse off? Well, the only way you can really do that is to artificially link those things to the base currency in which you operate. And everyone has a different base currency. I know some people's base currency is Bitcoin, which is quite fascinating, but ours was still USD. And so you had to have that. And then going back in time a little bit for probably a lot of your listeners, there was a time when there were only a few exchanges in the world which allowed you to deposit fiat. And for various reasons, those exchanges had very few other tokens. Now, there weren't nearly as many as there are today, but they only had a few, 3 or 4 tokens. And all of the fun and the action was in what we called alt exchanges. An alt exchange was an exchange that didn't take fiat. So how did you get on the alt exchange? You would send your fiat to one of these very few exchanges that took fiat. You would acquire Bitcoin. You would withdraw the Bitcoin and send it over to the alt exchange that listed all kinds of tokens you might be interested in. But then every few weeks, you might be feeling anxious and thinking a big bout of volatility was about to hit. And what do? Well, that was another problem we were trying to solve. And the way you solve that would be normally, you would sell all of your alt tokens for Bitcoin, transfer the Bitcoin back to that exchange that allowed fiat. And those exchanges didn't generally allow you to store the fiat there. So then they would wire it back to you. That whole process took 7 days. By that time, you wanted to be back into the market, rinse, repeat. And so our thinking was, what if there was a token that did not move relative to USD? And there are various ways to skin that cat. I believe Tether did it the absolute best way. We thought of all the other ways because this problem wasn't new. Many economists had written about how one might do something like this. And when you look at things like Luna and the disastrous consequences of the way they created the collateral backing the stablecoin, that was both something we thought of and was obvious to us as a loser idea. And the beauty of Tether is its simplicity. You know, it is not pegged. That's a very important fact. There is no peg to Tether. And that was critical.
Yeah, let me stop you there because I really want to lean into this, William, because I think that there's a real misconception. And I think a lot of our listeners probably do not understand how Tether is pegged to the US dollar. Can you just
It's really not pegged to the US dollar.
Not, I was going to say, I'm letting you say that.
Yeah, Tether has never been, it was never designed to be. A peg is like a horrendous point of failure. And I realize a lot of people in general, probably your listeners, are not students of central banks and global financial policies, but all nations' currencies are free floating. There is no stable coin of the realm. All currencies have no intrinsic value. Their value is based on a trading value with another currency. And those values are always moving, right? USD and yen and RMB and euro, they all move every second. And central banks have a treasury, which they will sometimes deploy to either drive down or drive up the value of their currency relative to other currencies, because the value of your currency can affect the competitiveness of your imports and exports. And so we don't have a national currency or a national treasury. And, George Soros famously broke the British central bank when he started to attack the value of the pound in the 80s. So we're certainly not, set up like the UK. And therefore, for us, there could be no pegging. So there is no peg, guys. We have no opinion as to what the value you want to trade your Tether for. Trade it for a penny, trade it for $5. It's irrelevant. Because Tether has no peg. Tether is redeemable for $1. That's all your users have to understand. Tether is redeemable for $1. There's no peg. What that means is if somebody wants to sell you Tether at 90 cents, buy it. You're buying dollars for 90 cents. If somebody wants to sell you Tether for $1.10, maybe don't, but maybe sell it, right? And as your viewers, especially if they're global, will see, the value of Tether differs based on different exchanges. CoinMarketCap has a composite price, which hovers very closely to $1. It's really nice, right? Maybe $1 and 0.01 cents and 99.8 cents. And sometimes people will ask me, well, why doesn't it trade for exactly $1? Well, why doesn't any currency hold its value relative to another currency? It may orbit very closely, but it's never going to be exact. And the simple reason is exchanges around the world are local monopolies, effectively. The people in Indonesia, or used to be China, in Europe, most of them are going to use one exchange that is familiar with them, that will KYC them, that will onboard them. And therefore, the supply of crypto on that exchange is really their universe of what's available. So if you're in, let's say, Korea, and there is a movement away from Bitcoin at the moment because people are worried that Bitcoin's going to drop, they're going to look for a safe harbor. That safe harbor is going to be Tether. So there's going to be a huge spike in demand for Tether, but a fixed supply at that second. And therefore, those people holding Tether may be able to command a price above $1. And the reverse would also be true. If Bitcoin is in a quick run up, people want to liquidate Tether and get into Bitcoin, they may be willing to sell their Tether for less than $1. It doesn't change the fact that it's redeemable for $1, but at any given moment, if you see a profit-making opportunity or you want to avoid what you perceive to be a risk of a loss, you might be willing to trade your dollars for less than $1 exactly. And so hopefully that explains the pegging and the fact why we don't have one and why it moves relative to the dollar, even though it is redeemable for $1.
Mm-hmm. Mm-hmm. That's great. Yeah. Thanks for explaining that, William. I want to sort of zoom out for a second. Stablecoin market cap currently, all stablecoins globally, is about $170 billion. Can we just talk about the impact that stablecoins are having on DeFi, crypto now, but maybe more so where you see this going in the future?
Sure. First, I'd like to say, I'll answer it in two ways. The second way is about opportunity as a venture capitalist. But first, stable coins are, and I'm just going to be like parochial and just say Tether, because I think Tether's the best. But Tether is the circulatory system of crypto. Without Tether, crypto in its current form does not exist. If you look at trading volumes, essentially every traded crypto trades against Tether, but in addition, the only trading pair that matters is Tether. That's something a lot of people are surprised by. The only trading pair that matters is Tether. Nobody really trades even Bitcoin these days for Ethereum or Bitcoin for Solana. That's just not a thing. Mm-hmm. And it's not a thing because of the problem I talked about earlier, which is you're trying to figure out what your profit is. And if both things are moving, you really don't know at the end of the day whether you're better or worse. You do when you have a token indexed to the base currency that you use to calculate those profits. So without Tether, and okay, I'll say all trading, all stable coins at this point, trading volume in crypto would drop a minimum of 75%. I also believe the value of all crypto globally would drop 75%. Without Tether, crypto doesn't really exist in the way we think about it today. That's how meaningful the invention of the stablecoin was. I'll add one other point, which is that DeFi really is requires three ingredients to exist. You need a ability to post something as collateral, so a smart contract. You need the ability to calculate what it is that you're trying to do, which is the stable coin. And then you need a yielding mechanism. So with collateral and a stable coin and an ability to earn yield, you mix those things together and you get what we call DeFi. Any of that three-legged stool going away means DeFi goes away. And so this giant category of crypto called DeFi would not exist without stablecoins. And so that is sort of one side of what I want to say. Now on the venture capital hat I'll put on, and this is for those of your listeners who are sick of being W-2s and wage slaves and ultimately want to build a business one day, which is a great thing to do. When we did Tether, not only did no one, it had never been thought of before, the very concept hadn't been thought of. But once people learned about it, and I'm not talking noobs who don't know crypto, I'm talking about crypto OGs. Virtually all of them thought it was a dumb idea. Virtually all of them. Not only that, it took us a good year to explain what it was. And this was, even for me, I've been a venture capitalist since the mid-90s, and I've done a lot of stuff that people couldn't understand why you would need that. Even for me, I was surprised. It seemed quite straightforward. But I realized you really had to take a deep dive into crypto and understand. I had been building blockchains for 3 years before I really knew what a blockchain was. But I was going through that exercise, being very curious. What is this really? I do think if you cannot explain to anybody the topic in which you're focused on, then you're probably not an expert. Because you should be able to explain it. God forbid when you try to get people to explain what a blockchain is, most of the times I can't even understand what they're saying. So, but I thought we did a good job of explaining Tether, but it turned out a lot of people weren't really actively trading crypto at the time, so they didn't really see a need. They also were stumped by this idea that it had an off-chain element. And of course they were preoccupied with this question of, but how do I know the money is there? I actually never thought that would be a problem, and I was proved to be right. I didn't think that would be a problem if people had trust in the people who were launching it. And so I would say to people, even Tether, even stablecoins, which most people now say, well, duh, how could nobody know the value of a stablecoin? Well, prior to it existing, people didn't. And so that should say, if you have an idea, and a lot of people are either scratching their head or saying it's lame, don't consider that to be an indictment of the idea and something you shouldn't go forward on. If you really have what I consider as a VC, the most precious element in the universe, and that's deep insight. If you have deep insight about why something should be used or created, then don't worry about the fact that other people don't, because most people are not curious. And most people never go to that extra step to figure out what's missing in this puzzle. People are very good at telling you, what color they would like in a new product category, or make it cheaper, make it smaller. But if you ask people what's missing from what you do that would enhance your trading ability, your living, very few people are going to be able to do that exercise. And I think stablecoins are such a perfect example of that. Something that is, in retrospect, incredibly obvious, but at the time, people couldn't comprehend why it was needed.
And I like this perspective of stablecoins being incredibly obvious, because I'd like to shift gears slightly to a conversation of where this is going in relation to governments and monetary policy, because where we are right now is we're in this monetary policy cycle that we've been in since about 2008, constantly printing money, debasing our currencies. And that has led to this situation that the whole world is in, where we have inflation and recessions, or the government's not allowing recessions, and it's not typical business cycle. And we don't need to get into that conversation. We talk about that lots. We talk lots about on the show about macro. But what I'm curious about is what is the relationship between Tether and governments? Is there conversations happening? Is there a relationship? And where do you think this goes long term? There's been talk about CBDCs for a long time, but we haven't necessarily seen that yet. Do you think that governments are going to try to control stablecoins eventually? Curious to get sort of your larger zoom out government perspective on the future of stablecoins.
Yeah, and briefly, right?
Yeah, sorry, I packed a lot into that question.
So I will go. I'll try to be brief. Of course, all of the developed world central banks are aware of Tether, and they're aware of stablecoins. I made a prediction in 2015, and I guess I still think it can happen. Maybe it'll take a little longer, but I thought by 2030, all of the world's major economies would have tokenized their fiat. And the reason is because there are very few innovations in life that only have upsides. They have no trade-offs. They're only better, right? Stablecoins are one of those few things. It's only better. It only enhances fiat for it to be tokenized. And I figured it would take 15 years for slow-moving governments to figure it out, but many of the things they want to do can be done if they tokenize their currency. Now, many governments are on the process of developing what now is called a central bank digital currency, even though it's digital, but it's tokenization and digitalization are radically different. So I don't think it should be called digital. It should be called the tokenized fiat. Many governments are doing it. The US was rapidly moving towards that until Powell noticed something in probably on TikTok, which caused him to pause. And I remember his quote was something to the effect of, we're going to be evaluating this over some period of time in order to see how we might do this. And the reason was because on the internet, like a couple of years ago, a bunch of conspiracy people started saying that, oh my gosh, with the central bank digital currency, the government's going to be able to know about your purchases and money movement. Now, for your audience, just let me say something. That was laughable to me. I've been in the payment space for like 20 years. That was laughable to me because the US government has been able to track every damn dollar of what you do for decades, people. It's insanity. All of your wires, if it's in USD, have to be tracked using something called a suspicious activity report, which is just if someone in the bank thinks you're suspicious. The US government can subpoena any credit card company and see every dollar you've spent. It's madness that you would not want to tokenize your currency because you think the government's going to do something with that when the government's been doing that for 20 years. So that shouldn't be the reason to be afraid. Now, kind of in that question you asked me about is a question I've pondered for many years, which is, if central banks around the world begin to issue digital currencies or tokenized fiat, what happens to the private issuers of fiat? What happens to those of the Tethers of the world? And I've done work with different groups who have been pondering the same thing. And there's not time here to go through it, but think of it as almost like a decision tree. The central banks say, we are going to issue a tokenized fiat and no private issuer will be allowed to. So Tether and all the stablecoins, private issued stablecoins disappear. That would be the worst case scenario, because the very reason the central banks are issuing a tokenized fiat is because the private markets invented it. And once government does anything, all innovation dies. Government does not innovate. So is it likely that private markets are going to continue to evolve and innovate around stablecoins? Of course, but not if you outlaw the private market from issuing them. So that would be the worst case scenario. A mid-case scenario might be central banks issue their tokenized fiat and say that stable coins issued by private issuers have to be subjected to a lot of the rules that cross-border payment processors do now. And that may cause things like DeFi to be harder to do, because DeFi operators would have to be trying to do that KYC and AML function that really is hard to do in a blockchain-based environment. So stablecoins could still exist. You could still own them on an exchange, whatever, but you would maybe not be able to use them in the way we like to use them. And then the best way would be that central banks issue their tokenized fiat, and they have no opinion and do not interfere with how the private markets treat their privately issued stablecoins. And that in that scenario, you would have the greatest amount of innovation and use of stablecoins, because the private issuers would always be pushing the envelope of what could be done next. So I don't really know which way it's going to go. You know, there's a chance of any of those things happening. Certainly the fact that the US Federal Reserve has really paused, based on Powell's remarks, the speed at which it's going to issue a central bank digital currency. I think we have probably 5 years or so in the US to figure this out. And that's probably good. And maybe at that point, Tether and its like will be so prolific that they'll be hesitant. The regulators will be hesitant to kill off the private market.
Yeah, I think we're certainly in a scenario right now where, as you said, we need the innovation, we need the private market, and it is allowing us to move at this rapid speed that the governments could never move at. Right. I hope that the governments don't slow us down. And most likely, this is a government by government, nation by nation situation where different governments are going to respond differently and they're going to have different approaches.
True. But just like banking law is supposed to be linked to the jurisdiction in which those banks exist. So why is it that US banking law is global law? And it is global law. Which is annoying. Even in China abides by US banking law. Why? Because banks only have value if they're connected to other banks. And the US, through the Patriot Act and then Dodd-Frank, two abysmal pieces of legislation, have created horrible tortures that they will inflict upon banks that don't comply with US banking law. And so the US is probably the one country that could severely restrict privately issued stablecoins, even issued in countries with deposits in banks that aren't US banks. Whether they will or not, I don't know. You know, when Powell said last year, I think the way he phrased it was, in the coming years, is what I remember saying. In the coming years, we will be looking to research. When I hear a Fed chairman say in the coming years, that sounds like never.
That's decades. That's like a century.
Yeah. In the coming years, like what? I mean, if a corporation said that, I would say that's 5 years out.
Yeah.
Coming years, who knows? He's probably just kicking the can down the road to the next, head. for that person to make the decision. Maybe with Gary Gensler, more than likely, stepping down, whoever wins in the U.S. presidential election, there will be a more crypto-friendly SEC, which probably, since that's part of the Treasury Department, would have some kind of positive effect on stablecoin issuers. So yeah, I think stablecoins. You said at the beginning, if nothing else had happened with crypto but stablecoins, that would be good. I would agree. I would say stablecoins are such an innovation in the history of money. They second only to the invention of fiat. That stablecoins, if nothing else happened in crypto, crypto's market cap of 10 trillion, I think, would be justified just by the existence of stablecoins. And probably a lot of people not in crypto don't understand how important they really are. And let's face it, when a government says, like El Salvador last year, we're going to own Bitcoin or whatever, because people are going to use it. Bitcoin is a failure, and that shouldn't be controversial as a payment system.
As a payment, yes.
And read the Bitcoin white paper. It was designed as
system,
which is fine.
Which is okay.
Lots of things were designed for a use that never happened, and they're still useful, right? But stablecoins, Tether wasn't designed for DeFi, but DeFi came along, and that's great. But if you were going to get the advantages of a tokenized item for especially for cross-border, it would look like Tether. So what should have happened already is many companies around the world should be using Tether as a form of payment, and particularly cross-border settlement, where most people just want a fixed amount of something. They want to invoice you for something that costs 1,000 USD, and they want the equivalent of that in euros or whatever it is they're taking. They don't want to be subjected to the FX volatility because that's not their business. And so it is a puzzle to me why more businesses haven't started using things like Tether, but maybe this cycle, this bull market run in 2025, they will.
It's when you break it down like that, it seems so obvious. And I think when you explain stablecoins to a non-crypto person, it is very difficult to get. But when you ask them how they send money across borders, they get it instantly.
And I would even go further. I've been in the payment space for a long time. I was the first institutional investor in PayPal, back in the 90s. I also I began my career as a bank auditor. The movement of money, the payment systems, payment rails, even excluding cross-border, but add cross-border, very few people working in finance, working in treasury groups in finance understand this. Very few. And so your CEO or whatever is never going to understand this. I mean, when someone in Germany sells, sneakers on eBay to someone in the US, and they get euros, there was no euro going back and forth to complete that transaction. PayPal was never exposed to that volatility, and the dollar to euro outrageous 4% or whatever it is exchange fee, they never incurred that. That is pure profit. One of the things I would like your audience to know is that when we think about how something like a stable coin could lower the cost of doing payments and remittance and all that, people always tend to focus on the stipulated fees charged by credit card companies or financial institutions that actually do the currency conversion and all that. But the reality is the stipulated fees, 1%, 2%, the interchange and all that is irrelevant compared to the cost of converting that currency. I think I've done back of the envelopes over the years. I think the annual cost in a roughly $80 trillion global economy, I think the cost of currency conversion is somewhere between 750 billion and 1 trillion annually. That is captured by about 5,000 proxies of the government. Remember, you're not allowed to touch currency going back to biblical times unless the king or the government grants you special dispensation to do that. Money exchangers are pure profit makers. They're always aligned with governments. You have to have a government permission to do it. And those 5,000 institutions, which collectively get somewhere between 750 billion and 1 trillion, think about that's every year. And remember this is not revenue. Revenue has a cost of goods and you get a gross margin. This is pure profit, right? 1 trillion pure profit. So if you never needed to engage in that currency conversion because you held the currency you received natively, then all the businesses and the consumers of the world would keep that $1 trillion annually. And so the reason why Tether and these other stable coins is so incredibly disruptive is because it is a way to offset $1 trillion of value extraction annually that has been going on since like cross-border trading began, and letting people keep that and do something more productive with it. And it's also why I think many financial institutions are so wary of it. And it's also why I think if we get a CBDC, how I see it going, and people in crypto will find this disgusting, but I see it going like this. The financial institutions themselves are going to use this tokenized fiat, but they're still going to charge you currency conversion costs, even though they're never doing any FX. I'm sure that's going to happen.
Oh, yeah. I mean, you're right. Why wouldn't they?
Why
they don't want to
wouldn't
give that. They don't want to give that profit up.
No way.
No chance. Right?
They're
too entrenched. They rely on that profit for their business at this point. They're too heavy.
Try to get PayPal to tell you in their financials what % of their transaction revenue is from FX. You know, it's even when you're a big customer of theirs, and I have been, that's not something they want to share with you. What they do is they try to keep you focused on the stipulated fees. Mm-hmm. You know, William, you're paying 1.8% for the interchange for the credit card. We're going to lower that to 80 basis points. Mm-hmm. And you're like, tell you what, you can keep it all. How about you let me in on what it is you're assessing me when I convert from euros to dollars? You know, and that's when even the salespeople don't know.
And if they won't tell you, and if they don't know, it's too good. There's a reason.
When I first posed this question to my account managers, they were confused because they had never understood this. These were people working for PayPal for years. They're like, what are you talking about? And I said, when you get me the name of someone and their title has something like treasury or cross-border FX, and yeah, eventually that happened. And I understood how profitable this was for them. Mm-hmm. So this is why it's so disruptive for something like a stable coin.
And when something is so disruptive, there's going to be a lot of challenge in pushing it through. We all know that disruption is always gradual. It is always gradual. And then all of a sudden, the term that we always use in crypto, and I think we will see that moment when that happens with stable coins. Tough to say. William, I think we're going to have to end here because we're already over time. but we're going to have to get you back on for a part 2 at some point in the future, because this has been such a great conversation. I just want to give you a chance to tell people where they can follow you, and if you have any final thoughts that you want to share.
I'm not easy to follow because I'm usually working. I have a Twitter account, William E. Quigley, at William E. Quigley. And I post, shows like this, things that I do, and educational stuff I do. And I probably should comment more on things that I see, because I have a perspective that goes back many decades in banking and venture and now crypto. But I haven't much so far. But you can certainly see when I'm doing shows like this, I'll post them there. And yeah, maybe in December or something, when the whole market is supposed to be going on, we can talk about what that means wherever Bitcoin is. And I'll leave your audience with, if Bitcoin isn't close to 100,000, 90 to 100,000, that should be of concern in terms of using past patterns, following happenings as an indicator of what's going to happen in 2025. So I don't tell people I think it's going to go between 90 and 100,000 by December. I just say if it doesn't, what that will mean is we are no longer on the patterns that we've been historically, which means it's much more difficult to know what to do going into 2025.
I like the subtle price prediction, William. Thank you so much for joining us today. For everybody listening in, remember, none of this is financial advice. Investing in crypto, investing in any asset is risky, and you should only invest what you can afford to lose. Thanks so much again for listening in. We'll see you next time. Have a wicked awesome day.